One of the greatest concerns that people have when they're thinking about getting a whole life insurance policy is knowing which company to go with, which company is best for you. And in this video, what I'm going to walk you through is going to be the 6 questions and steps that you need to ask yourself and that you need to evaluate to know how to decipher which whole life insurance company and what policy design is going to be best for you, your life, your goals, your objectives. And that'll be, I think, by the time this video is over, you're gonna have a lot more clarity on what company is best for you, or at least how you can make a better decision. So if you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's get into it. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and for this video, we're gonna be talking about how do you decipher which company is the best for you to start a whole life insurance policy with, or maybe to get a second policy with, or how do you ultimately know how to evaluate which is the best? I think one of the biggest mistakes that people make is they go out and they just try to find a company that is maybe big, has a huge balance sheet, has a lot of history, maybe the biggest general fund possible, and at the end of the day, that's not always the best thing. In fact, seldom is that really the best thing. And so in this video, we're gonna walk you through what you need to evaluate. And so the first thing that I wanna talk about, that I want you to think about, is to think about, do they do business? Does the company do business the way that you want to do business? i.e., do their values and beliefs about life insurance align with yours? Now that sounds like a weird statement probably to some people, but the bottom line is, if you follow this channel and you're interested in utilizing life insurance as an asset, I think you got to be really careful on which companies that you go with. There are certain companies that simply don't advocate for utilizing your policy as kind of a banking alternative, like an emergency fund type account, and they don't want a lot of loans early in the policy. Don't get me wrong, contractually speaking, every company has to allow you to do loans. But there have been companies that have threatened termination to agents if they have too high of a percentage of their business that takes loans early in the policy process. And so when you look at that, and I consider that, I think it's really important. One of the most important things that you can do as somebody who's looking to buy a policy is to make sure that your agent is there for you and that they're the right person to help support you through the whole process, not just getting the policy, but execution of the policy as you go through your years of implementation. Now, if there are companies that are threatening termination based to agents based on the fact that you, the policyholder, are going to be too active with the policy too early, well, that's not in alignment with your values and beliefs and why you want to utilize this. And if the goal is to have a good agent, then if you reverse engineer that, it makes it really challenging to work with a company that's going to terminate the agent if they're not in alignment there. You know what I mean? And so when you look at that, I think making sure that you're not kind of pigeonholing yourself into working with an agent that is not in alignment with your values necessarily and beliefs and how you want to execute with this policy based on the company that they're aligned with and kind of what they are restricted to do, I think is really important. So that's the first thing that I would say, is make sure that the company is in alignment with your values and your beliefs, and they're going to allow the agent to support you in a way that you want to utilize this policy. All right, so the second thing I think you need to consider when choosing a life insurance company is their ratings. One of the things that I like to do is look at the Comdex ranking that the company has. Now, there are different ratings companies out there, but what the Comdex does is they basically rank the companies according to their ratings across the rating systems all the way across the board. And so they basically take all your research and they make it really, really easy for you to decipher what are the rankings of these companies as far as their ratings with the ratings agencies. And so to me, the Comdex rating is the place to start when we're looking at these companies. Now, once again, I'm not saying ratings are everything. I'm not saying this ranking, the Comdex ranking is everything, but I am saying that it is part of the equation that you want to look at. When we're looking at financial stability, I don't care so much about the size of the company, the size of the general fund. I care about the health of the balance sheet of that company. One of the things about participating in mutually held whole life insurance companies is the fact that they are not able to take the risk. They're not speculating. They're not leveraging. I think a lot of times back in, like the Great Recession, when companies like AIG got into a lot of trouble, I think that gave insurance companies a bad rap because they had good ratings and they had good rankings and ratings with these ratings agencies, and then they still needed to be bailed out. I think it's important to understand that AIG, companies like that had to get bailed out, were not participating mutually held whole life insurance companies. And when you look at the Comdex rating, I think it's also just vital that you understand as you go through, because there's 130 companies on this list, that are ranked in the insurance business according to Comdex rankings. And I think it's really important that people know the difference between a participating mutually held company versus a stock company versus a mutual company that's not participating in nature. Companies like State Farm, companies like Allstate, companies like Nationwide, they are mutual companies, but they're not participating mutual companies, meaning the policyholders, the whole life insurance policyholders, are not participating in the profitability of those companies through the payment of a dividend in the policies, right? So if we're going to get a policy, a whole life insurance policy, we want to use a participating mutually held company, and we want those rankings in the Comdex to be as high as possible. A low Comdex ranking simply means more risk, but if we combine the participating mutual with a high Comdex, that's an amazing combination with a much higher chance that that company is never going to have any problems. Now, I will say this. Obviously, there are no guarantees, right? As far as the company's solvency and viability and so on and so forth. But I will say that only one participating mutually held company has failed over 200 years. And when you compare that to the fact that 3 banks have failed this year alone, this is one of the big reasons that I'm a huge advocate for utilizing a whole life insurance policy when it's properly designed as an alternative for your emergency fund and your opportunity fund that you would traditionally keep in a savings account at a traditional bank. And so that's that. That's number 2, the Comdex rankings. So the third thing that you need to evaluate is the direct versus non-direct recognition of a dividend rate. So what is direct versus non-direct? It's one of the more confusing topics in the participating mutual whole life insurance space. People, I think, overplay and oversell the value of this. There's a lot of infinite banking people that will tell you and swear by the fact that because of the fact that with infinite banking, when you're taking policy loans, we don't want to directly recognize those loans against the dividend, right? Like, we want the dividend to not be impacted when we're taking loans. That is a non-direct recognition. And a direct recognition means when you take a policy loan, the amount of that policy loan is going to be directly recognized against the cash value in that policy, so it will reduce the dividend. And so infinite banking people that like to use the cash value, sell the non-direct recognition as a huge value. And don't get me wrong, I like the clarity, I like the transparency, I like the simplicity of that. But it's important to understand that it's not necessarily that straightforward. And I think it's important for you to understand the difference between the two, and to understand that it's not one good, one bad. I mean, I do personally have more of a leaning towards the non-direct recognition, and that's cool. But I'm not saying that direct recognition is horrible either. I want to take a second and I want to show you something here. And I'm going to go to my board here real quick, and I want to talk about how this works. So it's important to understand. I draw this sort of graph out a lot because I think it's really important to know. So we've got 2010, 2023. We'll just do this. So in 1979, we had like 19% interest rates. They went down to 0% interest rates, and now they basically laid flat, and then they've been going up, and we're at like 5.5% at this point in time. So this is the interest rate that, so Y equals interest rate. And this is going to really have an impact on the direct recognition versus non-direct. And this is going to equal the dividend rate. Okay? So what happened is, well, if you look back back here before inflation went crazy, we had like 6% interest rate that went up, literally skyrocketed overnight. Now, here's the deal. When we had the dividend rates here, the dividend rates are always trailing interest rates. So it's really important to understand that these rates trailed, and there's always a lag. So there's a couple years for this to catch up, but then there was a crossover point on the dividend rate, and then the dividend rate went down. Now, I've done this several times. I've done videos on this that go into more detail, so I'm not gonna spend a ton of time on this. But I think what's important is to understand that during this time, a lot of people have talked about the benefit of the non-direct recognition is the fact that because interest rates were low, that kept the Moody's bond index was low, and that kept loan rates were low inside of the policy loan provision. And for a direct, and what happened was dividend rates were higher. And so that created this kind of arbitrage environment for the past 10 years. And of course, that's when social media got popular. And because it was happening at that point in time, this space here allowed for a positive arbitrage to happen with non-direct recognition policies. But that doesn't mean just because environmentally and circumstantially that was happening and that was going on and it was factual and it was true and nobody was lying to you or deceiving you or anything of that nature. And I'm going to erase this so I can kind of draw it out a little more. But what it does mean is that as interest rates go up, and let's say they hit 8% hypothetically, because that is the max cap rate that you can have on a loan from a policy. Now we have dividends that are going, let's say they're at 5.5% right now, right? There's going to be a crossover point. And this crossover point, by the way, has already occurred. And so now dividend rates are going to chase interest rates up. So even on some of these non-direct recognition companies, the loan rate has superseded, has gotten higher than the actual dividend rate in the policy. My problem and my challenge with this concept as a whole is that a lot of these influencers online that are talking about the benefits of direct or non-direct recognition are not talking about the fact that in this environment, the loan rates have gotten more expensive than the dividend rate. Now, does that make infinite banking not work? No, it doesn't. That's not what it's about. Infinite banking is not about positive arbitrage. And my challenge is that these people have been selling the concept on this time period because it was simple and it was straightforward, and they made it look like it was a principle that this window that you could build this positive arbitrage and all things were good there. But that's not what it's about. And if people don't understand that it's infinite banking and the power of whole life insurance and all the ways that you can use it is not just about positive arbitrage, well, then you're missing the boat right now. So what is the big deal behind that? And I'm gonna pull this up. So with a direct recognition company, it means that if you have a 6% dividend and then you take a loan, the dividend may be reduced to, and let's say the loan is 4%, the dividend may be reduced to the equivalent of the dividend. So it'd be like a wash, right? Meanwhile, the rest of the money in the policy that doesn't have a loan out on it will be earning the full dividend, right? Like, so if you had $100,000 and you took a 50K, and this is cash value in the policy, 50K loan, so that would mean you had 50K left in net cash value available after the loan. So this would be earning 4% because it would be directly recognized and reduced, and this would be earning the full 6% in the policy. So it's just more to track in a direct recognition. But here's the deal. Right now, when we look at this, the benefit of a direct recognition is they can typically offer a higher dividend because they have more control, because they have the ability to lower your rates, right? And they typically offer lower loan rates. And so depending on how you plan on using the policy, and I'm going to get into that in a second because that is the next deciding factor on how you decide what company is right for you. But depending on how that goes is going to determine, which kind of company structure, direct or non-direct, that you prefer. The reason that I personally prefer the non-direct is because I think we can't think about things in terms of just like our time frame right here. I always kind of tell people you cannot solve long-term problems with short-term thinking. And we have to understand that during our life, right, we're going to have this policy for 30 years. And if this is the interest rate environment, it's going to go up, it's going to go down, and that's just the cycle and the nature of things. And so what's going to happen here is, for this period, non-direct might be better for this period, direct will be better here, non-direct will be better here, direct will be better here, non-direct will be better here. So it's not a matter of good or bad. It's about understanding really how it works, making a decision that's best for you. I like the non-direct recognition element because there's less moving parts, there's more transparency, it's easier for you to see all the things and really understand what you're involved with. And you, as the person in control of the policy, it's easier for you to measure your decisions as you go through. That's why I like it. But it doesn't mean it's necessarily going to perform any better. I think that's important to understand. So let's get into the next factor that I think you need to consider, taking all of this into consideration. And that factor is the dividend rate versus the loan rate. Now, I know I just touched on this in the last one, but it's really important to say, some people focus on the fact that, this company has a 6% dividend and it looks really good and it illustrates really well. But that doesn't really matter. Illustrations don't matter. As soon as you get the policy, the illustration is going to change based on the fact that you plan on utilizing the capital in this policy. So if you get a company that has a 6% dividend, or 5.25%, or 5.75%, or 5%, or dividend rates are kind of anywhere between undeclared, kind of in the 4.5% range, all the way to 6%. Those are kind of the company ranges at this point in time. Looking at that just on in an isolated environment, obviously the 6% looks better. But the bottom line is there's no free lunches in this life insurance space, and every company is kind of managing their risk, because that's what these companies do. And they're figuring out how they want to manage their risk and manage their business and manage the value that the policies will bring to you, the policyholders. And so from that perspective, the companies with the higher dividend, typically, if they have a high dividend and a low interest rate and it's non-direct, well, then that's obviously the best scenario, right? But typically speaking, direct recognition companies are going to have higher dividend rates, lower interest rates that are going to impact you, right? So you have to think about the next step, which is, how do you plan on using your loan? You have to consider the dividend rate and the policy loan rate, but then you have to think about, how do you plan on using this loan? Because as soon as you take a policy loan, the illustration doesn't matter. That's what I just said, right? So when we look at how you plan on using it, let's say real estate, you want to borrow against it for real estate. Well, if you know that you're going to pay it back fast, then that's one thing. But let's say you had a choice. Let's say you had a chance. I'm going to pull this up here just to kind of run through an example. So you could get a company that pays a 6% dividend. But if that company, is compared to a company maybe paying 5.2% dividend, well, the question is, which is better? It's not that one is better than the other. It's about understanding that there's more to the conversation than that. And the challenge is, too many people sell it just on this and just on this because they don't think you're going to be, sophisticated enough to go through and seek out all the other information that's needed to make a good decision. And this is the important stuff. So now we have the loan rate. So the question is, what's the loan rate? Well, and this is not an exact example. I'm just saying this is something you need to consider. If the 6% dividend rate is like 7.5% on the loan rate, and the 5.2% dividend is only 5.5% on the loan rate, well, now we have to really figure out, what is the impact and the cost of this loan? How do you plan on using this money? How fast do you plan on using it? How fast do you plan on paying it back? Is it going to be used for real estate where you're going to pay it back over a 10-year period? This 7.5% is much higher than this. We're talking about 40% higher. So you're going to have about 40% more in interest expense on that loan. And so all the while, this 5.2 may not be as crazy, but now we have to look at, is this 5.2 direct or non-direct? Chances are, if it's higher, if it's a higher loan rate, it's going to be a non-direct recognition, because that's how the company protects himself, where a direct recognition is gonna say, if you got this 5.2, they're gonna reduce the dividend to 4-ish, hypothetically, and the loan rate wouldn't be here, it would be 4% as well, right? So you just have to, this game comes more into the equation when we're talking about non-direct recognition companies, because those are the companies that have the negative arbitrage and the ability for the loan rates to go higher than the dividend rate. Once again, it's important to know, right now, every company has increased their dividend rate, increased their loan rate higher than the dividend rate if they're a non-direct recognition company right now. And I think that's really important to understand. So the final thing that I think you need to consider is the paid up additions flexibility. We all hear the conversations about the value of paid up additions and the blend of a policy that go into paid up additions. So one of the things that I want you to think about is not just the fact that it's not just about the blend of paid up additions, but it's actually about the functionality of those paid up additions. Let me get into this a little bit. And so when we look at the paid up additions, there's a couple things that we have to think about. Is the cost of the paid up additions, and then the flexibility of the paid up additions. So some companies have anywhere from 5% fees to start the paid up additions, and some companies are charging as high as 11% as a front load fee for the cost of those paid up additions. And so that expense on the front end is not inconsequential. Obviously, it's great, it comes with liquidity, but if we can reduce the cost and the fees, we'll just say fees of the PUAs, that's really important. Now, the other thing is the flexibility. We talk about the fact, let me kind of break it down like this. Let's say you had a $10,000 per year premium, and hypothetically speaking, you did a 40-60 blend. Typically speaking, it's going to come with a term rider. So what's going to happen, and I'm just kind of winging this, but like the base would be $4,000, because that's the base coverage. Now, a lot of people would think that the rest of the 60% goes into paid up additions, but that's not the case, because anytime you do a blend with paid up additions, right, because this is the PUA part, anytime you do that, there is a term rider that has to go. So the term rider is going to be, let's just say, depending on your age and how long you're doing it, obviously, but let's just say it's $1,000 a year, right? So out of that, now 10% is the term rider, and now you're going to also have the PUA front load charges. That adds and becomes a drag on the policy. It's important to understand that dividends are only paid on the permanent insurance. So yes, the paid up additions will be there, but when we look at the PUAs, you're going to have maybe $5,000 going into PUAs, but then when you take out the 11%, you may have like $4,400 that actually goes into the PUAs after all the charges on the front end. So really, a 40-60 policy becomes, kind of just watered down a little bit, and this $1,000, depending on the age, depending on the length of the term, that can become a big drag and a fee, and then the 11% fee when you count for that. If you go with some of these companies, the PUA fees can be higher and the blend can be a little detrimental. So if we did a 1090 policy, just to kind of break this down as to an example, the base is going to be $1,000, right? The term is going to be more, because why? Because we're putting more paid up additions in. And so in order to put more paid up additions in, we got to put more life insurance in the policy to keep the policy from mecking. And so now that term insurance is probably going to be $1,500 per year. Once again, these are just ballpark numbers, but we're just talking principally speaking. And so now what does that mean? That means the PUAs are going to be like $7,500, but once again, we now have to minus the 11%, because that's going to be the fee. I'm saying the worst case scenario for these companies. And so then at the end of the day, we're going to have, let's say, like $6,700 that actually go into the PUAs plus the 1,000. And so now we got 7,700 in a 1090 policy. And when we look at that, that's a much higher percentage of inefficiency, because you got $2,300 that are going to, this PUA fee and the term rider fee that you don't earn dividends on long term. And this is the reason that I always kind of say, yes, paid up additions are great when you are looking for short-term liquidity. Don't get me wrong, I love it. There are situations where a 1090 policy makes the most sense. However, if you are looking for whole life insurance to solve multiple problems in your life, to use it as an emergency fund, an opportunity fund, for real estate, if you want it there for long-term care benefits, if you want it there for the living benefits, for alternative medical treatments, for a volatility buffer in retirement, having a higher base is going to give and provide a bigger dividend. Because remember, this 23% effectively that you're losing on, the $2,300 here, there's no dividend on that money, right? There's nothing there. You only get paid on the 7,700 that goes into these other, into the paid up additions and into the actual base coverage. So you need to understand, at the end of the day, these are the processes. Sorry, I made a mess of my board here. This is the process: does a company do business the way that you want to do business? What are their rankings on the Comdex? Is it a direct versus non-direct? How is the dividend rate compared to the loan rate? How do you plan on utilizing the policy? And now let's talk about the flexibility, because I just talked about the cost and the fees and all that stuff of the paid up additions. But the bottom line is the flexibility is also really important to consider. A lot of companies have it set up so if you could start with the paid up additions, but they're very fixed. And if you don't pay the paid up additions every single year, you don't have the ability to make up for the payments that you didn't make. You don't have the ability to keep contributing the paid up additions in the future at the same rates. So it's important for you to understand and make sure that the company you're working with, A, doesn't have crazy costs on the paid up additions, and B, doesn't, it has very flexible paid up additions. And so there's always a balance that you have to take into consideration. That's why I always say to people, the best policy design is really the policy that's designed to meet your goals and objectives. It's not as simple as just doing a 40/60 or a 1090 or anything of that nature. So hopefully you found value in this. If you did, please like it, share it, comment, get it out there. If you have any questions, I'm happy to engage with any comment possible. One of the things I'm doing is I'm trying to go live at least once a week to spend that time doing responses to comments to add more value to the community here. So make sure if you have any questions, comment, like it, share it, get it out there. And that's it for this one. Hopefully you found value in this. Have a blessed, inspirational day. We'll talk soon. See ya.